From downtown Milwaukee, welcome to Money Talk with Bob Landaas. Each week, professional advisors from Landaas Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
This is Money Talk for September 23rd, 2022. Checking the calendar, the Brewers are winding down their season, and starting Tuesday, they're home for the last 9 games of the year. The Pack is with Tom Brady and the Tampa Bay Buccaneers Sunday afternoon in Florida. Here's hoping nothing weird happens to them while they're down there. And let's not forget Harvest Fair, Pet Fest, and Festa Italiana. They're all happening this weekend. In Taiwan, to celebrate Mid-Autumn Festival, it's kind of their Oktoberfest, a veterans retirement home hired 2 strippers to entertain the elderly wheelchair-bound veterans. I guess it's their way of saying, thank you for your service. One last bit of Queen Elizabeth news. Guinea Pig Week, Awareness Week, was canceled to honor the Queen. I'm not sure what's more alarming, the cancellation or that they have a week-long celebration for guinea pigs. Whether it's TikTok or YouTube, people still do stupid stuff. The latest video craze is the Sleepy Chicken Challenge. You marinate and cook your chicken in NyQuil. The FDA has warned that these are dangerous and could even be fatal. I'm pretty sure NyQuil isn't one of Colonel Sanders' secret ingredients. And speaking of fast food, at a Popeyes in Mississippi, the employee spotted an alligator at the drive-thru. At my Popeyes, a gator at the drive-thru is just another speed bump. And our headline of the week, a Florida man desperate for a ride to Hooters called 911. On the podcast today, we have our Rothschild, PAIGE, RADKE, Joel Dresang, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Max. Anytime we can get Florida Man into the podcast, I always appreciate the headlines. Rough week overall for markets. The NASDAQ down 5.1% this week, closing at 10,868. The S&P down 4.6, closing at the bell at 3693. The Dow Jones Industrial Average 484 points down today, down 1,230 points for the week, closing down 4% this week at 29,593 for the year. The NASDAQ now down 30.1%, the S&P down 21.6%, and the Dow just a little better, down 17.3%. Worth pointing out, a pretty significant bump in the rate on the 10-year Treasury, moving up 25 basis points this week to close at 3.7%. And at the same time, dollar up pretty substantially again this week, and crude oil down pretty substantially. So some signs of potentially, recessionary fears as the Fed continues on this journey. Art, you mentioned a couple of weeks back on the podcast an anecdote from your grandfather. It appears it was certainly timely, but perhaps something maybe needed to for you to add to that statement.
Yeah, the comment was little ships should stay close to the shore, and at this point it's batten down the hatches. Or we could call this Shark Week, just when you thought it was safe to get back in the water. It's a reminder that we never know what's going to happen or when. Some good things about this week, though. The Fed reiterated, its stance for the most part. And what the market didn't like about what they did, everybody knew they were going to raise rates 0.75%. But they, for the most part, have increased the level to which they think interest rates are going to be raised, and it lengthened the time period over which they will likely remain higher. Again, as I commented a couple weeks ago, Chairman Powell has suggested that this is not rocket science, or it's not physics, was his terminology. And he, during Jackson Hole, commented on pain that was going to have to be felt. And they did that. He did that deliberately because the markets were excited because they were expecting the Fed to look at some positive signs and slow their interest rate rises. And I think the investors now realize they're serious, and for good reason. Inflation is not a good thing. The big difference this week is, of course, the rest of the world is joining in. Even though the United Kingdom is clearly in or going into a recession, they're raising rates. Europe's raising rates. And our rates going higher, it doesn't mean they're not going to go, higher yet. But it doesn't mean we should turn tail and run. It just means we should understand what we have, why we have what we have, and how tough it is, to stay in the market when the going gets tough. Again, when the going gets tough, the tough get going. I think that's important. And then 2 more adages, and then I'll be quiet for a minute here. Don't fight the Fed. We've said it before. I'll say it again. And don't fight the tape. And they're going in the same direction. And the Fed is, quite frankly, I think, happy that the markets have responded in a little more sober fashion to their messaging. Because if the stock market goes up too much, people feel too wealthy, spend too much money, and that's not a good thing. So it's a week that could be expected. It's a week that happens every once in a while. But again, understand what you have. Call us if you have questions. It's not a time to turn tail and run.
Are you hearing from clients at all who are saying, okay, so why do I have what do I have and why do I have it?
So every time I get a call from a client who has a concern, they always ask, gee, your phones must be ringing off the hook, or they imply that. It's not the case. But the number of calls, the number of emails, are increasing, but our clients hire us to give them peace of mind. So if they have that peace of mind, they're just confident that they're going to be fine regardless, and hopefully they can go about their business and just live their lives. So no, it's not huge volume.
And knowing you, I mean, you probably, besides all the adages, you probably share that with them every time you see them, is to say, this is what's in your portfolio and this is why.
Absolutely. And as we've talked about so often on the show, you shouldn't be focused on the stuff that's going up and down the most, meaning stocks. You should focus on the safe things in your account which enable you to go about your life spending what is an appropriate amount to spend. So you have to have the right focus. Now, that having been said, if they're uncomfortable with their allocation to equities, then they should definitely scale back. I mean, Bob quoted me on the show years ago for the comment, it's never too late to reallocate. And I'm not sure I ever said it, but I like the fact that he said I did because it's got a nice ring to it. And so definitely, if you have concerns out there, call your advisors. Ask them what you have, why you have what you have. And there has been a sea change, sticking with the metaphor. The growth stocks that did so well, for a decade at least, and did so well as we recovered from the pandemic, are taking on the most water, sticking with the metaphor, at this point. And value stocks are indeed holding up better and may well do better during this time of uncertainty. So, we're making adjustments on a regular basis, in response to clients, and generally because we think it's the best thing as times change and people get older, myself included.
I think it's important to point out that the time to sell may not be while you're in the middle of all this pain as well, right? That if you've gotten through to this point okay, if you're not overly concerned about what you have, now's probably not the time to give up on what we think long-term is going to work, because the reality is not all that much changed this week. Down, as I mentioned at the open, another 4% for the Dow, another 4.5% for the S&P, and yet there wasn't all that much economic data. There wasn't all that much changing tide. Again, going to some of your metaphors here, Art, there wasn't all that much of a changing of the tide with respect to kind of our expectations for the market. We've been expecting earnings growth to slow. We've been expecting the economy to continue to show signs of some weakening. It's all by design. I don't even think what the Fed said was that drastically different than what so many of us have come to expect. I think what's going on here is simply that as every little new piece of information comes out, the market is doing what it does, which is overreact short-term to what the long-term impact of this is going to be. I don't think we saw that much different. What is interesting to me, and Paige, something that we look at quite a bit, is what a lot of the rest of the world is doing now to combat some of the issues, whether it's, tax cuts in the UK to potentially spur some economic growth there, whether it's Japan trying to defend their currency. Everybody seems to be playing the game now in ways that we haven't seen for a very long time.
Yeah, I mean, looking abroad especially, I think that some people have some questions about why would the European Central Bank be raising interest rates at a time when we're concerned about going into winter and the price of oil and what that impact is going to be on the people that live there. But the reality is we have to remember that the dollar continues to be very strong relative to other currencies. And a big part of that is because the Federal Reserve is raising interest rates. And so when you look, overseas, as they start to raise interest rates, you might wonder why. But really, it's the same reasons we are. It's trying to combat inflation. And when you add to that the strong dollar, they have the double impact. And so if they don't start increasing interest rates along with the United States, they have the impact of, again, the slowdown along with inflation and the strong dollar. So they have a lot of work to do ahead of them. I don't know that they're going to be quite aggressive as what we've seen here in the U.S. But again, it makes sense from an economic standpoint for them to continue to raise interest rates. And then, like you said, Japan has intervened in their currencies for the first time in a long time. Contra to what we're seeing in Europe, Japan is not increasing their interest rates. And so that's why they're having a little bit more volatility in their currency market. And I think that now is a good time to reassess how much do you have abroad. There's a lot more issues there. As bad as we feel like it is here in the U.S., it's worse over there. And so they have a lot of catch up to do. They have a lot of, reassessing of their currency and their debt. And so I'm keeping a close eye on that. But going back to one of the things Art said before, one of the real issues right now, of course, is the Fed. The big question is how high are rates going to go and how long are they going to stay there? In the June meeting, when they came out with their expectations, they were thinking that by the end of 2022, the federal funds rate would be at about 3.4%. Now the expectation is all the way up to 4.4%. But looking forward, 2023 staying about the same. 2024 is when you start to see it going down. And by 2025, the FOMC is predicting about 2.9% on the overnight rate. And so we have an expectation of where things might go. But I think when it comes to Powell and his comments, one of the most important things that he's trying to do is change our mentality. We have very much a have your cake and eat it too idea here in the U.S., where we're going to complain about inflation and rising prices, and we're going to complain that the Federal Reserve is raising interest rates and what that's doing to portfolios. You can't have it both ways. So you really have to look at that and remember that, yes, prices are high. And as they start to, continue to raise rates, we're seeing the impacts of that in financial markets almost immediately. Bond returns and stock returns show that. Mortgage rates going up show that. But consumer spending hasn't really come down yet. And so when the Fed says things like painful and concerned, what they're really trying to do is change the psyche of consumers here in the U.S. and allow them to recognize that they're going to have to change some of their spending habits at some point in time. In an ideal world, we could just keep spending and have things keep going up, but we can't do that and also bring inflation down. And so as they make these remarks that are definitely causing jitters in the stock market, they really are trying their best to have people understand that something is going to have to change. And if they don't start to see that, they're going to be more aggressive in their interest rate hikes. So they're attempting to allow those consumers, allow investors to reassess today, and so that they can see those impacts a little bit faster and then be a little less aggressive with their rate hikes.
And all this pain coming at a time when, at least at the start of the year, stocks were overvalued. And so we kind of saw maybe a bit of a pause just based on valuations alone. You add in all the challenges of the Fed raising interest rates. And, I think the good news is the path here has been pretty well understood. Yeah, it's been painful to go through, but it isn't something where you look back and go, how did we get here? And I think that's helpful for investors to understand now what the road ahead looks like. Paige, you point out kind of long-term expectations for rates. It's not all that comforting when you're in the middle of it to know that there is light at the end of the tunnel. But let's remember that we're in the tunnel right now, and eventually, if we keep driving, we're going to get out of it. I think the other piece of this is I mentioned, just a second ago that we started this with valuations a little bit elevated. Well, now valuations are a little bit cheap. We've gone the other direction. Very cheap if you look at recent memory, but even relative to longer term perspective, Art, the one challenge there may be what happens to the earnings piece of that price to earnings equation. But ultimately, I think we've got a little bit of cushion now on prices that we didn't have when we started the year.
Yeah, and you went over earlier in the week when we had our advisors meeting this point about the earnings this year, if anything, are inflated by the earnings of energy companies that are doing well. Now, that'll go away next year. But one of the reasons I think stocks did sell off this week, it wasn't only the Fed, it was concerns about further adjustments to earnings. A week ago, the market was spooked when FedEx indicated that their profits were going to be lower, and they ended up lower, and they could go lower still. And then this foreign stuff that Paige mentioned, the dollar strength is not a good thing for U.S. multinationals. And quite frankly, I think the analysts have been a little behind in ratcheting down their expectations with respect to earnings, in part because the foreign earnings are being translated now into less dollars. And not to mention when they have a recession over there, which they're going to have, and with China slowing, they're going to have a recession, there's going to be less sales. When there's less sales, there's less profits, and we may see further revision. So I think investors are being appropriately cautious. That doesn't mean we should sell. I totally agree with you. But we have to be aware of what's going on, and we have to realize that there could be more selling ahead until we get out of that tunnel.
Joel, a bunch of economic news the last few weeks, a little bit quieter this week, but quite a bit on housing, an area I think that's been in focus given where mortgage rates have moved north of 6% now for kind of the benchmark 30-year. Clearly signs that the housing market is not as healthy as it used to be. That's right,
Kyle. Last week on the show, Dave Sandstrom mentioned how mortgage applications have, gone south because of the interest rates, the higher financing costs for buying a house. This week we had numbers from the Commerce Department on housing starts and building permits being sort of a future indicator of how things are going, and those are down. We've seen building permits going down 5 months in a row. They're 20% below their recent peak, which was just recently in December, and that was the highest numbers for building permits since just before the financial collapse, so back in 2006. At the same time, housing starts are also kind of weakening, but they're not as immediately impacted by interest rates, because you've got a house that you're starting to build. You can't just sort of all of a sudden stop building it. So it's interesting because right now in August, the latest numbers we have a record number of houses under construction, and that's in data going back to 1970. So that's covering a lot of time. Now the hope is that with a lot more houses being built, that eventually and demand, being softer because of the high interest rates, that maybe housing prices will stop going up as much as they have been. But meantime, those housing prices are still pretty high, and a big part of inflation is shelter costs. So that's a big factor that's not going to come down real soon in what we're seeing as far as the inflation numbers.
And the survey of leading economic indicators, another kind of, I think, big thing that we watch for kind of future expectations.
Yeah, that comes from the Conference Board, which is a business research group, and they're saying that the latest numbers are suggesting that we're headed for a possible recession within the coming quarters, and that shouldn't be any surprise. As we were talking, the Fed is trying to fight inflation, and one of the costs of that is slowing down the economy to the point where it's actually contracting. Another factor of all this is employment. And when Paige was talking before about consumption still being up and people still buying, well, they're emboldened by how good the employment market is right now. The latest numbers we had on unemployment insurance claims those are still going down. They've been using the 4-week moving average. It's the lowest it's been in 3 months. It's 41% below the 55-year average. So we have signs yet that the employment market is strong. And as long as that happens, despite what the Fed's saying, despite what the Fed's doing, I think consumers are still feeling a little cocky and willing to spend their money, which isn't helping the economy slow to the point where inflation is coming down.
Well, in a week where markets were down as much as they were, where interest rates are up as much as they are, I think it's always interesting how little actually changes from a big picture perspective. I don't think my outlook is drastically different today than it was 7 days ago. I don't think there's a ton different about our economic outlook other than the fact that maybe prices are a little better now. And so I think cautiously optimistic about what the path forward looks like. Always a challenge to go through the kinds of markets we're going through right now. But I think, a reminder that this kind of stuff is not atypical, that, it's helpful when you know how you got here as opposed to being surprised. And I think most importantly, clear that, the Fed is going to do what it takes to solve the problem that is inflation, even if that means that there is some more of this short-term pain to come. So, again, I think that's the point to remember here, is that this is all part of what has very much been clearly communicated, clearly part of the plan. Well, thank you all for listening. We enjoy doing the program for you. We'll talk to you again next week.
Thank you for listening to Money Talk with Bob Landaas. If you have a financial question you want answered on next week's show, email it to moneytalk@landaas.com. To keep informed throughout the week, visit our Money Talk page at landaas.com.